Hello and welcome to this market update with SKAGEN Kon-Tiki. My name is Fredrik Bjelland. I'm the lead manager of the fund. The things I thought we would cover today is just a recap. What is the fund? How do we invest? And what is the team behind it? We'll go through some of the key drivers behind 2025 and the strong returns that we saw in emerging markets during that period. How is the portfolio positioned today? And then just a couple of words on how we see the outlook and the opportunity set going forward. As I said, my name is Fredrik Bjelland. Been the manager on Kon-Tiki now for just over 8 years. I manage the fund together with my co-manager Klette, who has also been working with the fund for a number of years now and joined us in January 2019. We are a so-called Article 8 fund, which means that we take ESG considerations into our fundamental analysis of the opportunity as we see them. And depending on the share class, the fund has 3 or 4 Morningstar stars and has received a 4 out of 5 rating from Lipper for its results over time. So what is SKAGEN Kon-Tiki? It is our emerging markets fund. Like all the other SKAGEN actively managed funds, it's a bottom-up stock picking fund. Our philosophy has been the same since the fund was founded in April 2002, and we use a benchmark agnostic and quite free generalist approach to finding investments in emerging markets. As I mentioned, as an Article 8 fund, we have always integrated ESG principles, and we are an active owners for the companies that we hold, typically for a 3 to 5 year period. But one of the larger positions in the fund has actually been held since 2002, so we can truly say we are active and long-term owners. For us, it's important that the fund displays the characteristics that you would expect from the investment strategy that we lay out. So here you can see that the core characteristics of the fund in terms of being active, differentiated and value-based are very much in place. The fund has a circa 80% active share. It has come down a little bit over the last 3 to 4 years, predominantly as we have been building a large position in Taiwan Semiconductor, which unfortunately for us is a very large benchmark composition. You can see that other than some of the mega cap names in the universe, we also do have a small and mid cap tilt in the portfolio. And on the right hand side, you can see our relative weight in the portfolio relative to that of the MSCI Emerging Markets Index. So again, our fundamental and research intense investment process does uncover a number of opportunities in the smaller cap spectrum, because often that's where we find the more overlooked companies. Finally, in terms of valuation, even though we delivered strong returns both in an absolute and a relative sense last year, the portfolio trades at very attractive multiples, 8 times earnings, just over 1 times book value, which is a roughly 40% discount to the emerging markets index, which one has to acknowledge is approaching mid-cycle levels in terms of valuations. In terms of a track record, as I mentioned, we had a strong year last year. So when you look at the trailing 12 and 36-month performance, we have delivered quite strong both absolute and relative returns. And as you can see, as emerging markets equity is starting to come back into favor, we're hoping to build on that momentum and continue to deliver attractive absolute and relative returns over the long term. So I said we would start with 2025 and a review of what drove performance there. So if we start with the bird's eye perspective, it was generally a good year for risk assets. Here you see the Bank of America overview of where asset classes stood at the middle of December. Effectively, the more risk you took, the more you were rewarded, with commodities making up the bookends, both on the negative side and the positive side, with oil having had a pretty weak year, and gold, as many of you will have caught on, has had a very, very strong run. Within equities, US lagged behind predominantly due to a weaker dollar, whereas EM equities and particularly European equities did very, very well. So if we delve into the markets themselves, you can see that emerging markets, this is for the calendar year 2025 in euro terms rather than US dollars in the previous chart. Emerging markets outperformed developed markets by about 10 percentage points. That was largely driven by some of the bigger Asian markets, particularly South Korea, where you had a combination of structural reforms and a pretty significant cyclical upswing in the technology sector, driving that market higher. We also saw, as you would imagine from the commodity experience that we had last year, countries like South Africa, Mexico, and Brazil did pretty well, whereas more oil-dependent countries like Saudi Arabia did weakly. Countries that we often get questions about are India and China. China was sort of a middle-of-the-road country last year, but we did, as I will return to, have, again, pretty good stock picking in China, whereas India, a market where we have been more cautious over the last couple of years, continued to derate and actually had one of its worst 12-month relative performances versus the index for some time. And we are starting to see some value emerging in India, which we can return to. When we go to portfolio level, no surprises with Korea having been a strong market. It made two out of our top 5 contributors for the year. Samsung Electronics, which was a investment we have held for the fund's lifetime. We also upsized the position early in 2025 and got paid pretty well for that. We have over the years also had quite a growing exposure to Korean financials, and Hana, which is our remaining largest position, did very well as it delivered on its value up plan and continues to increase its shareholder returns, and the market is consequently re-rating that stock. Stock picking wise in China, both Alibaba and Ping An did well. We did sort of reduce our position in Alibaba during the course of the year because there was a big re-rating there on the cloud and AI related themes. Finally, on the positive side, TSMC, a stock many of you will know in emerging markets portfolio, also did well for us. And we have held pretty much as big a position as we have been able to under UCITS regulation in that name during 2025 and continue to do so into 2026. On the negative side, I did mention that Brazil was a strong market, but unfortunately some of our stock picking in Brazil left much to be desired. Both Cosan and Raízen are more levered names and they have sort of been weighed down by higher interest rates. We did eventually sell out of Cosan after the capital structure was repaired by a primary issuance of new shares. Petrobras, unsurprisingly, as an oil company, sold off on the back of weaker oil prices, but interestingly, we have seen that stock perform very, very strongly at the start of this year. If we then look at it from an attribution perspective, you can see there was a blend between sort of allocation decisions and security selection that played into our relative return. This is unusual for us. Typically, it's much more driven by security selection. But as you can see, we had a lot of tailwind from having a low exposure to India. But luckily, also the exposure we did have in India did outperform the markets. We got both a positive allocation and a security selection effect in India. The opposite was true in Brazil, where, as I mentioned, we had some stock-specific drawdowns. And I mentioned previously our security selection in China, where we did actually have a growing underweight position during the course of the year as we rotated the portfolio more to LATAM and Eastern European names. So let's move on to the portfolio today. And here we've just tried to group together some of the major themes that we think will drive the performance in 2026. Firstly, no surprise, artificial intelligence continues to be one of the key drivers of the market. We believe we've built up a pretty balanced exposure throughout the value chain where we can actually play the different risk reward depending on who's spending the money and where sort of that capex is going. We think we have a good exposure there. Value up continues to be a big driver of the market in Korea. We see company by company either voluntarily or involuntarily being forced to improve shareholder returns, and the market is really waking up to that reform tailwind. And obviously it doesn't hurt that Korea is also pretty well positioned for a number of the big investment themes, including AI, but also robotics, shipbuilding, aerospace and defense, etc., which has helped that market quite strongly. Finally, we do think that the easing cycle in Brazil could be underway. It is one of the highest real rates globally. Policy rate at 15%, inflation running sub 5%. We do think that there is scope to ease there, and that should put some tailwind behind equities. Obviously, we are mindful of the geopolitical risk there, especially with elections coming up. But if you go into those three themes in a little bit more detail, here's just an overview of what we sort of consider to be the AI exposure within the fund. A lot of the AI exposure you get in emerging markets is upstream from the likes of TSMC and Samsung, both as a foundry but also as a memory maker. That makes up about 17% of the portfolio. But we also think that Hon Hai, or Foxconn Industrial Internet in China, is a pretty good play, as they are one of the main assemblers of the server racks that go into the big data centers. And what we've seen there is that actually, as a purely a cost plus and assembly play, you are actually getting some pretty good operating leverage as the components you are building are getting more and more valuable. Another part of the value chain where we have sort of resized position a little bit is in the cloud and cloud side and LLMs, where at the start of 2025, Alibaba was one of our largest position, but as that's re-rated on the back of their pretty improved cloud performance and also excitement around their AI positioning, we have scaled back that position a little bit and instead moved more downstream into those companies that we think are doing a good job of implementing AI in order to make their business models more efficient. And a couple of examples there that stand out is Ping An, which has always been a technologically savvy insurance company in China. And they are getting some pretty good efficiency gains and cost savings from using AI. And as many will also have come across, Tencent as in terms of gaming and programming also means that their advertising can get more efficient, and we hold Tencent through Naspers and process. I won't go into as much detail in terms of Korea and Brazil, but I think it is worth just putting into context why we're finding opportunities in these markets. And that is simply as a value-driven investor, these are some of the cheaper markets on offer. Both are trading well below emerging markets index. As I mentioned, at 13 times 12-month forward PE, the emerging markets are starting to become sort of valued in line with their history. But both Brazil and we think Korea do offer some valuation cushion if you were to go into a more normalized period, especially if you were to get lower rates in Brazil. What have we done over the last year or so? Here you can see the changes we made to the portfolio. It's an unusually busy period for us. It's mainly driven by the fact that a number of holdings during the year met our target prices, and we have had a disciplined sell down, particularly in China during the start of the year. But as you can see, we've also sold down some of our commodities exposure, energy exposures, those re-rated during the course of the year, and we took profit in KB Financials, one of the banks in Korea, and recycled some of those assets into other Korean banks. Where have we been putting our incremental money? It's been quite a broad church, but what I would say where we're finding opportunities is in online retailers such as JD.com in China, but also Allegro, which is based in Poland, which has had a pretty weak performance since its IPO back in 2021. And we think it's come down to very, very interesting levels. We've also been able to pick up during the April-May sell down on the tariff noise. We were able to pick up some large export manufacturers based in Hong Kong, both Yuyuan Industrial Holding and Shenzhou International made their way into the portfolio during that volatility. And earlier this year, we have been initiating positions both in the regional bank Banbarrio in Mexico and the Brazilian clothing retailer Lojas Renner, which we previously owned as well. So if we go into the top 12 of the portfolio, As you can see, since our last update, there have been a couple of sort of changes in the overall weights. Samsung Electronics, on the back of its very, very strong performance last year, has drifted up from a roughly 6% position to a close to 9% position. We have also taken an active decision to increase our positioning in Asai, which is a Brazilian cash and carry retailer, which has sold off on sort of weaker top line momentum, which we think is temporary because it continues to be a market share taker. I mentioned we bought JD.com. That's actually made it into our top 12, and we see it as one of the most asymmetric risk reward propositions in emerging markets. You have a very, very, in our view, limited downside on the back of a big net cash position and financial assets that they could monetize. Management is buying back stock. They have a decent dividend yield, and at the same time, earnings are significantly depressed by new initiatives and international operations, whereas the core operations in China, although they have a weak top line, are still delivering decent margins. We have also reduced our position in Petrobras a little bit because it has re-rated significantly of late, despite the oil price not necessarily moving very much in the last 6 months since our last update. But if I can cast your eyes to the portfolio characteristics, we started the year in 2025 with a portfolio that traded at a 30 to 35% discount to emerging markets at 8-9 times earnings. We have been able to maintain that valuation multiple at around 8 times PE. So we have now, as I mentioned earlier, an even bigger discount to the market. So we feel pretty excited about the opportunity to find undervalued stocks still, if you just look in the less obvious places. So final section is just to remind everyone why we are excited by the long-term opportunity in emerging markets. It is simply down to the structural tailwinds to economic growth. On any kind of non-financial metric that you measure, emerging economies make up the vast majority of the world's resources. They are growing faster in terms of economies, and in terms of financial markets, they remain much less developed than here in the West. 20% of global market cap, only 11% of a global index fund. And as we've seen, a number of global investors have been underweight emerging markets for a long time, and flows are really starting to come back into the asset class because we are seeing the benefits both of low valuations, but also diversification benefits as concerns around the strength of the US dollar or recent weakening are starting to accelerate. So again, let's just put valuations into a long-term perspective. At 13 times PE, emerging markets are trading more or less in line with their long-term history. They are at a significant discount to developed markets and the US market themselves. So I think that in a historical perspective, although you had a strong 2025, there is still a long way to go in terms of relative valuation closing some of that gap. We're not arguing that emerging markets should trade at similar multiples such as they did around 2007, 2009, but some closing of that gap we think certainly is warranted. So just to round off, to again reiterate the message, we continue to manage the fund in exactly the same way that we've done for a very, very long time now. We offer a clear value-based investment philosophy with an emphasis on long-term and sustainable returns. That is how you can act as a long-term owner. The portfolio remains concentrated, less than 50 holdings, but is balanced across sectors, geographies, and most importantly, economic drivers. And what the stocks in the portfolio have in common is that they are, in our view, deeply undervalued on a range of scenarios that we use to set our expected returns on a bottom-up basis. And as we've seen over the last 12 to 18 months, both shifts in consumptions, concerns around geopolitics and global trade patterns, as well as technology disruption, is providing a pretty attractive backdrop for active value-based investors such as ourselves. So we hope that we can continue to deliver on our unit holders' expectations. And I thank you very much for your interest in the fund. Thank you.